There's a trading concept that rarely gets the spotlight, yet it's one that seasoned traders swear by, and it's often the defining factor that separates the winners from the losers in the market. This game-changing concept is speed. In today's video, I'm going to reveal the secrets behind this crucial but overlooked aspect of trading. Stick around because mastering this could be your key to trading success. Many people talk about what to do when price reaches a level, but very few talk about how it reaches that level. And overlooking this dynamic of price action is a huge waste of the information that the charts are giving you. Acknowledging either how fast or how slow price reaches one of our levels or zones can be very telling in what's to come, allow you to prepare yourself mentally for a certain outcome, and benefit from being on the right side of the trade. To explain the way speed works in the markets in the simplest way possible, I'm going to illustrate it in terms of energy. For this exercise, think of price as a living being. And just like you and me, price needs energy to move around. If it has a lot of energy, it can move efficiently, but when it doesn't have any energy, it gets tired and keels over. Here are two different types of price, price 1 and price 2, and both of these have to get from their starting point to a resistance level above them. Price 1 starts off thinking about energy conservation. It knows that it's a marathon, not a sprint, and to put in the most distance, it needs to think ahead. So it takes breaks along the way, pausing every so often, recharging its batteries, and continuing in an energy efficient manner. Eventually it gets to the resistance level, and although it's taken longer to get there, it's still got a good bit of fuel in the tank. Then you have price 2. This one decided to go for the full sprint, not taking any breaks along the way or even considering the fact it may have to conserve some energy. It gets to resistance as fast as physically possible, and although it's got here faster than price 1, by the time it gets here, it's exhausted. Now, I want to go through the way both of these moved again, but this time in terms of energy points. Both price 1 and price 2 start with 10 energy points, and their goal is to go as far as possible, past resistance and onwards. But to get past resistance, they'll need 5 energy points to do so. As we know, price 1 took multiple stops, and when it did so, it got back 1 energy point each time. It took price 1 in total 10 energy points to get to the resistance level, but as it took 3 pauses on the journey, it got back 3. So by the time price 1 gets to resistance, it's used up its 10 energy points, but gained 3. So it's left with 3 energy points in total. It knows that it needs 5 to get past resistance, but it doesn't quite have enough. So what it does is hover around underneath the level, building up its energy reserves until it has enough to break past the level with enough energy to do so. Price 2, on the other hand, didn't take any breaks along the way. So by the time it gets to resistance, it's used up all of the 10 energy points it started with. By the time it gets to resistance, it's completely out of energy and doesn't even have enough to consider hanging around and having a rest up here. Price 2 is exhausted, and as it knocks up into resistance, it fails, and with the effect of gravity against it, falls all the way back down to where it started. So we can see here, when thinking of price in terms of energy, how it's necessary to reset and recharge in order to carry on. There are, of course, exceptions in hyper-trending markets, but more often than not, we should be thinking about price in this way. The examples we just went through show why we hear things like consolidation under resistance is bullish or over support is bearish. And it also shows us that when looking at plays such as sweeps and deviations, we really want to see the level taken out with speed, as we know that it's running out of energy and is more likely to reverse. So with all that being said, we have to do some psychological retraining. Naturally, when we see price moving in an aggressive way, we regard it as strong. But if you start looking at price with your newfound understanding of energy, would you still feel this way? No. And as a result, you need to shift the way you view price, seeing fast moves as energy exhausting and unsustainable, and slower moves as energy conserving and sustainable. Now, you may listen to all of this and say this is silly advice, as I'm basically telling you to knife catch. In other words, something you wouldn't be so stupid to do, as the knife will cut through your hand. Now, make no mistake, this can happen in certain scenarios. You're now getting to a stage in the series where we are moving on to slightly more advanced concepts, and as a result, I don't want you to look at the charts and just go trying to counter trade anything that's very overextended. Rest assured that these are critical trading concepts, and if you integrate them sensibly into your analysis and execution, you can massively level up your trading game. Using our understanding of speed, there are two key concepts I want us to go through today, both used in the same way, but with very different appearances. These concepts are inefficiency and compression. You may have heard traders talk about terms such as efficiency or inefficiency and wondered what they meant. Well, the slower moves are the efficient ones, as they know they need to take breaks along the way. And the faster moves are inefficient, as they have traveled too fast and exhausted themselves. Inefficiencies are great pieces of trading theory that you can weave together with others for a reversion trade. What I mean by this is not playing the continuation of price, but betting on it pivoting and going the other direction. Inefficiencies are also known as liquidity voids or fair value gaps. Now, if you haven't already, you'll need to watch one of my previous videos, Supply, Demand, and Order Blocks, to understand this concept of liquidity. If you haven't, please do so after this video, but let's think again about the two price structures we ran through at the start of this video. Price 1 took a bunch of breaks on its journey towards resistance. Using your knowledge of supply and demand, what would you call these breaks? You guessed it, pockets of intra-demand. These pockets are not only where price pauses to move further in its direction, but also good buffers to support price if it loses a bit of steam. Inefficient moves, on the other hand, are the complete opposite. They both use up all of their energy and at the same time do so leaving no liquidity along the way. We saw this with price 2, where it ran out of energy and sliced through its move up with ease. Thinking in this way can give us the foundations of a great trade, as we both have the notion in our mind of price running out of steam, and that when it does so, we have a clear path ahead of the trade. Now let's talk about compression. Compression is another form of a liquidity void, not because there wasn't any liquidity, but because it's already been used up along the way. As we can see here, price moves down. As it does so, it creates these micro pockets of supply. But as it travels down, it gives us these small spikes back up into each supply zone that forms. As we know, supply is where sell orders are waiting, and as price taps into these zones, it uses up these orders, or in other words, liquidity. This happens over and over again, and by the time price chooses to reverse, it does so with speed, just the same as our inefficiency, as there is yet again a liquidity void as all the sell orders have been used up. This can be a bit tricky to get your head around, as at face value it looks like an efficient move as it's taking pauses along the way. So when studying the charts, try to apply this theory of liquidity being used up by these small little taps, and just remember that the lack of liquidity in either form is what's important. This, as well as everything else we've covered so far in this video, is of course applicable on the flip side, with demand being used up as price travels upwards. Again, these concepts are rarely taught and are somewhat counterintuitive to conceptualize. So do your best to retrain your mind in order to see the charts in a different way. If you found this video of value, give this page a sub, as there's tons more trading alpha in store. But with all that said, let's move on to our next video. One of my favorites and one of the tools you can use in harmony with speed to execute: divergences.